Money. No matter what currency you use, whether it be pounds, euros, or dollars, it needs to be stored somewhere. And that's where banks come in. In the UK, there's a group of banks known as the Big Four, including Barclays, Lloyds, HSBC, and RBS, which also owns NatWest. However, nowadays there are a number of businesses looking to change the way we bank and open the door to new ideas. But how did digital challenger banks become so popular and break the mould of conventional high street banking, which left us asking the question, is new always better? Here's how it happened. First, we have to understand what are challenger banks. They're defined as a relatively small bank set up with the intention of competing for business with large, long-established national banks, often specialising in areas underserved by the Big Four banks in order to have a USP, and they enter the market in three different ways. Firstly, divestment from larger groups, such as TSB from Lloyds, the wind down of a failed bank, such as Virgin Money from Northern Rock, and new entrants to the market. Challenger banks, however, are not new, with the aforementioned TSB and Virgin Money, as well as Metro Bank, who were, according to their website, the first high street bank to open in the UK for over 100 years, and they're open 7 days a week, unlike the Big Four. They all fit the bracket of high street challengers with physical branches. But nowadays, as we spend more and more time on our mobile phones, with over 3.5 billion smartphone users around the world, new challenger banks are focusing on digital strategies. Over the last few years, the UK has seen a number of new entrants in the market, all offering similarly new approaches to banking, such as Monzo, Starling, N26, Revolut, Monese, and Tandem. They all offer something slightly different to appeal to the generation that barely lifts their heads from out of their phones, and are more interested in completing transactions without talking to anyone. Many people today would rather order their shopping online, staying away from the supermarkets, or paying for their items with their smartphones without having to take out their wallet. Many people prefer to do things online, and some people even prefer not to type, using speech to text instead. So it's easy to see why these challenger banks don't need physical stores. But why are they popular? These new digital challenger banks are tapping into the digital age, offering a number of perks that come with each account, such as perks abroad, including no foreign exchange fees and the best rates, as well as free ATM withdrawals. They also offer perks at home, including instant notifications of payment and the location where you made the purchase, as well as being able to freeze your card and even set up a bank account straight through the mobile app. Finally, they also help with savings goals, splitting your account to provide a virtual piggy bank, rounding up your spare change, and tracking your spending habits to help you save for a big purchase like a house or a car. Each challenger offers slightly different features, and some were set up as new entrants to help foreigners obtain bank accounts abroad, whilst others stayed closer to home, as Tandem was born from Harrods Bank. Some accounts offer prepaid cards, whilst others are fully fledged bank accounts, and virtually all of them focus on mobile app control. You won't find many of these perks with the Big Four. As they have no virtual stores and fewer staff, the banks are also able to keep their costs down and therefore can offer customers better interest rates than their high street counterparts. But what happens if something goes wrong? Is my money safe in a challenger bank? In order to trade in the UK, challenger banks, just like any other financial institution, must gain a UK banking licence and are regulated by the Financial Conduct Authority. They also have to abide by the same rules as other banks, and most of them, but not all of them, are protected by the Financial Services Compensation Scheme, protecting up to £85,000 in deposits per account, so best to check before you sign up. It's no surprise that people would be nervous switching to a different bank, with a number of financial institutions failing after the global financial crisis, including Northern Rock, Bear Stearns, and Lehman Brothers. The stats also make for grim reading, as according to the Office for National Statistics, 57.6% of businesses started in 2013 were gone by 2018. In other words, fewer than half of UK startups make it beyond 5 years. Whilst Metro Bank is still alive and kicking, it is not thriving, and over the course of 2019, this challenger bank faced a number of difficulties, including seeing their eccentric founder and chairman Vernon Hill stepped down after a major accounting error, as well as having to raise more money from investors to meet regulators' capital requirements. 2019 saw the Metro Bank share price fall from over £20 per share to just £2 per share. This fall in value prompted the Big Four to start sniffing around at a potential takeover deal as they look to swallow up some of the competition. In the last 5 years, more than 3,000 bank branches have closed their doors across the UK. Of those that remain, many now operate reduced opening hours as fewer people actually want to go into a branch to speak to someone face to face. This leaves us with the question, can challenger banks succeed? It's important to look at both sides of the story, as challenger banks are able to offer better interest rates than the Big Four thanks to cost savings elsewhere in the business. And they also score better in the FCA Customer Service Review, which looks at how quickly you receive a lost or stolen bank card and how fast you can open an account from scratch. In a study of 2,000 people across the UK, 1 in 4 millennials, those under 37 years old, had a bank account with a challenger bank, which is possibly driven by the lack of trust in the larger institutions following the global financial crisis in 2008, where even the larger banks had to be bailed out by the government. What's appealing to a lot of people is that these banks are thinking outside the box. And by running everything through a mobile phone app, they actually make the whole process of banking easier. Despite the perks and positives that come with challenger bank accounts, it's important to think about what's not so good. Some of the new banks come with crazy valuations, which seems to come as standard in the world of fintech. Revolut's latest fundraising would see the firm valued at $10 billion, despite making a net loss of $40 million in 2018. N26, the Berlin-based bank, is valued at $3.5 billion, and the British challenger Monzo has a valuation of £2 billion. These new banks also have pressure to offer traditional services like mortgages and loans in order to generate more revenue to turn a profit. If these smaller firms are successful, then it's also possible that the larger banks will try a takeover in a bid to become more modern and obtain greater market share. And finally, the worry is that with startups going bust every day, are you keen to transfer your life savings into a bank that is less than 5 years old without the financial strength of some of the larger institutions? It might seem silly to worry about such a thing, but in 2019, Loot, a digital challenger aimed at students, went bust, having only launched in 2014, and even a £2 million investment from RBS couldn't save it. What's worse is that Loot wasn't covered by the Financial Services Compensation Scheme, but fortunately for its customers, their money was actually being held by Wirecard, Loot's card issuer, who protected and returned the money. Whilst new challengers seem like they're the future of banking, the Big Four in the UK continue to dominate, and their services such as mortgages are often cheaper thanks to their presence in the market. That being said, after regulations including obtaining banking licenses became more relaxed after the crisis to encourage competition in the market, more and more banks are popping up to offer customers more freedom of choice and more innovation going forward. Dr. Oliver Prill, the CEO of Tide, a digital challenger bank who are continuing to offer new services by focusing on business banking, suggests that in the past there was one universal banking model, and that's clearly broken. In the future, there won't be one model, and a healthy market should provide choice. As the traditional banks and the digital banks all fight for market share, now is the best time for the consumer. This leaves us with the question, is new always better? We'll let you decide that one. But one thing's for sure, new is always challenging. And that's how it happened. Please like the video and subscribe to the channel, and let us know what you'd like to see next by leaving a comment below. Thanks for watching.